Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It's already January. It is January the 3rd, Wednesday. We're already into January. The year is sort of kicked off okay. If you're in a variety of different stocks other than energy, you're probably wondering when are we getting the uptick? But if you're in energy, you probably have already experienced some of it. What I thought I would take a few minutes to do is just take some time and talk about the best oil stocks to buy for 2024, specifically the top 10. Now, what I try to avoid to do here is talk about the stocks that I talk about all the time, right? So I've made many videos on Occidental Petroleum and Energy Transfer and Devon Energy and all that kind of stuff. So I was looking for something else. So I was looking for a different source of information. And what I did for this particular video is I went to Kiplinger Personal Finance, and they have Wall Street's top-rated oil stocks. Now, at the risk of saying, I can't say according to whom when you look at all the analysts' consensus score and recommendations. So I'm just going to say according to Kiplinger and use that as a repository for all the stocks that the analysts are recommending. Now, right at the top here, you can see Targa Resources is a strong buy. This is their top 10. And there are a couple of highlights here, and that's why I put some arrows here where there are stocks that we've talked about before, and including videos that I've made before on different stocks like Schlumberger and Diamondback Energy. And for the greater part, I'm going to try and ignore Chevron. I don't have a direct equity position in Chevron, but I do have XLE, and Chevron is the second largest position in the ETF that we know as XLE, which is a dividend-paying energy ETF, and also a parking lot for me where I park some cash awaiting investment until I can find a deal. Now, I have shared a couple of videos where I have recently put some money to work, basically made a cash allocation into a couple of small cap stocks. And these include Sierra Madre, which is a silver mining company, and a little bit of gold. And at the same time, we have talked a lot about Colonial Coal as well. And what I'll do is at the end of the video, I'll park some of the links to those videos at the top of this video so you can take a look at them if you're interested in doing so. But back to energy, let's take a quick look here. And what I've done is I've broken them into two groups of 5 because I don't want to obviously share 10 different stocks on the screen at one time. So I'm going to do 5 and 5 in no particular order other than for the fact that they are ranked Kiplinger's top 10, but they didn't say Targa at number 1 is best and so on. So if we look at the actual exchanges that they trade on, 4 of these are on the New York Stock Exchange. 1 is on the NASDAQ, so 1 is the odd one out. That's Patterson. The other 4, Targa Resources, Halliburton, Schlumberger, and Permian Resources, trade on the New York Stock Exchange. In terms of industry, only 2 of them are more alike than the other 3. So of the 5, we have 2 of them in oil field services, and they are probably arguably more alike than disalike compared to the other 3. So what I've done here is I've gone into bar charts where you can also go. It's a website where you can compare up to 5 stocks at one time, and done a quick comparison to see how they rank one against the other and see if any of these might be of interest to us. And what I've also done is I've taken a snapshot of 2 of them. Sort of, I picked one in the top 5 and another one in the next 5, and just did a little screenshot of where they were today, so we can sort of look at those in a little bit more detail as well. On the technical side here, for the technical geeks, the 20-day raw stochastic, in case you've forgotten what that is if, generally speaking, if the percentage is above 80, it is hopelessly overbought. So now might not be a good time to get into it. And the only one that we see here at over 80% is Permian Resources. So maybe right now, that's not a great buy. At the same time, Halliburton and Schlumberger are edging up into the sort of 70s and mid-70s, so maybe they are getting close to being overbought as well. So the 2 sort of outliers here, to a lesser degree, Targa at 66, but certainly Patterson looks like a good buy from a stochastics point of view at 33%. However, even though the 20-day raw stochastic is 33.44, 88, so almost all the analysts are saying sell, and that's today's opinion, the previous opinion, and last month's opinion. So no one really wants to get into Patterson. So maybe for the sake of sort of, aligning myself with the technical geeks for a minute, I'll skip Patterson for now. On the other hand, Targa is a buy, right? So we have an 80% buy here, and last month 100% of the analysts said buy. So a big buy rating there. A couple of red ones in the middle, and sort of 50-50 on the fence here on Permian Resources. The PE ratios in general don't look too bad. We really want to get into a new stock, again, from a general point of view, if you use this one as a benchmark, with a PE ratio of like 15 or below, because that's sort of where the market is trending or sitting right now. So two of them look good. Permian Resources at 9.7, and Patterson with a PE ratio of only 7. But at the same time, it's got a very favorable stochastic and a very negative analyst ranking. So I'm not too sure about that one. We can take a look at Permian Resources in just a minute. What I've done here is I have taken the fundamentals and I use the market capitalization or market cap, which is also sometimes called market valuation. And in case you've forgotten what market cap is, it's the total number of shares outstanding by the current share price. That's how you derive market cap. In other words, how valued is the company today based on all the stock that is outstanding multiplied by the current stock price. And then what I've done is I've looked at the third row here, which says annual sales. And I've taken the market cap, so using Targa Resources as an example, the market cap of almost $20 billion and annual sales of almost $20 billion, 92%, and done the same math for the others as well. So Halliburton and Schlumberger, 159 to 63, and then look at this one, Permian, 495%. So if you look at this as a benchmark, you could say from a sales point of view, it is only, in relative terms, generating $2 billion in annual sales, but it has a market cap of over $10 billion, which means the stock price might be a little bit inflated right now. So maybe now is not necessarily a good time to get into it based on the little calculation that I'm doing on screen here. And then over here on the far right-hand side, we have Patterson with about 2.6 billion in sales and a $4.5 billion market cap, sort of more in line. The other way to look at this is you can say to yourself, if I were to buy a company, it doesn't matter what it is. Let's say, for instance, you wanted to buy a McDonald's franchise. And let's say, just to make it real easy math, if the McDonald's franchise is driving $1 million in revenue on an annualized basis, how much would you pay for the McDonald's? Would you pay a multiple on that revenue, or would you pay a one-to-one? So like, for instance, in the case of Targa, the company's valuation right now based on the market is sort of one-to-one, right? So whatever it's doing in sales, that's approximately its market cap. Or are you prepared to pay a premium? So if we look at Halliburton or Schlumberger as an example, let's take Schlumberger. It's doing 28 billion in sales. Would you pay $74 billion for a company that's driving $28 billion in sales? Now, another way to look at that is to say, let's not look at annual sales, but rather let's look at gross profit and net profit, earnings per share, etc., and then decide if there's valuation that allows me or affords me the opportunity to bid a multiple on the actual annualized revenue that it drives. So when you see a number greater than 100%, you need to ask yourself, am I prepared to pay more than, for example, 1 year's worth of annual revenue for this particular company? On that point specifically, I'll just add another comment. Companies that drive recurring revenue, so in other words, contract revenue. So by way of an example, let's just use McDonald's again. That's one-time revenue, right? I could go to McDonald's today and buy myself a hamburger and not go to McDonald's again for another year or 6 months or whatever the case might be. Maybe I'll even go back to McDonald's in 10 years from now, right? So that's one-time revenue. It's not recurring revenue. Whereas on the other hand, if you take your, let's say, your cell phone provider or your internet provider, you might be paying them, $30, $50, $100, $200 per month. That's recurring revenue. It's contracted revenue. Companies that generate recurring revenue certainly are more likely to get a multiple on their revenue than companies that drive one-time revenue, right? So at the bottom of the screen here, you can see most recent earnings. They all have positive earnings, and they all actually pay a dividend as well. So I'm not going to linger on that one. But I want to show you this graph here. And as you know, I'm not day trading. I'm a sort of buy and hold type investor. I look for an undervalued stock and just hold it. So this graph shows you 3 years of history. And if you had invested during those 3 years, and probably especially at the beginning of the 3-year period, look at this purple line here. This is Permian Resources. You would be delighted at your 455% return on investment. However, if you had invested in any of these, you probably would have been okay, because the worst performing one over here, the green line, is Patterson at 66. All the others have done really, really well. And you've even on target doubled your money, so if you can double your money in 3 years, that's pretty good, because it takes a 15% compounded growth to double every 5 years. So if you can get 191% over 3 years, you've done really, really well. Never mind Permian Resources up at the top here at 455%. So let's take a quick look at this company and see whether it's worthwhile getting into it right now or not. My immediate response would be to say no. This is a small cap value stock. You can buy it for about 14 bucks. It has a market cap of about $7.5 billion. It's outperformed the market indices significantly. The colorful lines here at the bottom, respectively, are the Dow Jones at the bottom, the S&P 500, and the NASDAQ. It's got positive earnings, it's got a PE ratio of just over 15. It's a little bit rich. If it pulls back a bit, then it might be a better time to get into Permian Resources if you were inclined to make an investment at all. It pays a little dividend. It's currently yielding 1.5% because it pays 20 cents on a $13.81 stock. It's sitting just to the right, sort of between the midpoint and the 52-week high, which was $15.49. Now might not be a great time to get into it. More importantly, right down here at the bottom of the screen in the middle, short interest has now crept up to 12% of the total outstanding float. So effectively, there's more than 10% of the float currently outstanding sold short, which means that many, many traders are expecting Permian Resources to pull back. If this pulls back, for instance, below $10, it might be a good buy, and I might look at it again right now. I wouldn't want to necessarily allocate some capital into Permian Resources. Let's look at the next 5, and I'm going to go a little faster here because I took a long time explaining the previous 5, so I can speed up a little bit here. Similarly, I have one on sort of outliner here, Diamondback or FANG. It trades on the NASDAQ, the other's traded on the New York Stock Exchange. I have 2 that are sort of the same, ConocoPhillips and Marathon Oil, both U.S. oil integrated. Of course, arguably Chevron is the same, but it's more international than Conoco and Marathon. And by the way, all 10 of these stocks are predominantly or mainly sort of US type focused, including Chevron. But once again, these 2, ConocoPhillips and Marathon Oil, are more alike than the other 3 that are included in this top 5. The 5 here, so this would be number 6 to 10, Diamondback, ConocoPhillips, Chevron, Marathon Oil, and Unjustifiably. So let's take a look at the stochastic here. This is a horrible picture. Remember, I just explained that if, generally speaking, if the stochastic, the 20-day raw stochastic score is above 80, it is overbought, and it's probably a better time to take some cash off the table and sell. And as you can see, almost all of these are overbought, and even the 2 that are below 80 are almost at 80, 76, and almost 80 respectively. The PE ratios don't look too bad on 2 of these, so well, 2 of them look better than the other 3. Diamondback at 8.3 and Marathon Oil at 8.6. Just at a glance, I'll tell you now that I would probably lean to adding Marathon before I add any of the other 4, and I already have a relatively small indirect position in Chevron because I have a large position in XLE, and XLE is 20% or thereabouts Chevron. But the PE ratios don't look too bad, so if you use that as a benchmark, some of them look like, in fact, all of these look like they could be potentially a good buy. Marathon looks the best of the lot. Again, the same calculation here. I've taken the market cap and divided it by the annual sales, and we're looking to see if we want to pay an uptick on the annual sales revenue that it's driving, right? So we're talking about gross sales, and we should rather perhaps look at gross profit and net profit, but this is the metric that I'm offered in bar charts. I'm working with this. Here we have about a 1-to-1 on Chevron and a 1-to-1 on OVV. The others are sort of similar here. We have Conoco and Marathon almost at a 2 times multiple versus revenue. And then I have a 3 times on Diamondback, which means that it might be trading a little bit above where it perhaps could be a good point to make an entry or to open a new position in this particular stock. If I look at Marathon here, which is sort of the 5, perhaps my favorite, around about half, right? So I've got a 200 uptick to 200% multiple here because I have $7.5 billion in sales and 14 and a bit billion dollars in market cap. So Marathon is valued at approximately 2 times annual revenue or annual sales. They all had positive earnings as well, much like the other 5 that I just showed you, and they all pay a dividend as well. So if you're a dividend investor, you might want to look at that too in terms of adding it to your portfolio. Over the past 3 years, how have they done? Well, none of them have done as good as PERMIAN Resources, but PERMIAN Resources is also the one that has the highest percentage of float sold short at 12%, right? So what I have here is Marathon has outperformed the rest of the bunch. Again, it's 3 years, 2 times, right? So we have a couple that didn't do too badly at all, and the laggard down here at the bottom is Chevron. But Chevron is one of those stocks that you can buy and you can pretty much just hold forever. You can park it in your portfolio, and you don't have to trade it at all. You can just hold it. You'll be okay. Chevron is kind of like Exxon or BP or Shell or one of those super majors, Total. If you buy it, you can just hold it. You don't have to trade around it. You'd be okay. It'll go up and down, but you'll be okay in general. But you're never going to do really, really great, right? So my pick of this bunch here is Marathon, and on the previous 5, it was PERMIAN Resources. Let's take a look at Marathon quickly, just as a quick snapshot. It's a mid-cap value stock. You can buy for about 25 bucks. It's got a market cap of about $14.5 billion. It's got a PE ratio of under 10. It's quite attractively priced. Pays a 44 cents dividend, which currently yields 1.8%, almost 2% on a $25 stock, right? So the 44 cents is an annual dividend divided by the stock price, gives you 1.8%, sitting slap bang in the middle of its 52-week range, which hovered between 20 and 29.85. So it's not a lot of movement there, right? We have a $10 range, and it's sitting in the middle at 25 bucks. Unlike PERMIAN Resources, the short interest is only 2.6, which is actually kind of normal. But over the past 1 year, you can see that Marathon has significantly underperformed the 3 indices, which is the opposite of PERMIAN, that has done really, really well. Now, what comes up must come down. So you could argue that PERMIAN has done so well, it might be pulling back and coming down soon, whereas Marathon, on the other hand, has been a laggard. And because it's been sort of trading behind or below the indices, including even the stodgy old Dow, maybe it's time for Marathon to get a bit of an uptick. And we see where we go from there. So according to Kiplinger, as I said at the beginning of the video, these are sort of the 10 best stocks to buy for 2024. Now, in my energy portfolio now, I mentioned a few of them at the start of the video. So the ones that I've spoken about so many times, right? Petrobras, Occidental Petroleum, Devon Energy, Energy Transfer, Enbridge, etc. And of course, I have a huge position in XLE, which is my parking lot. Whenever I have cash awaiting investment and I don't know where to put it, I put it in the sector that's more likely to outperform everything else, which is energy. And my parking lot remains XLE. Guys, let me know if you have positions in any of these 10 that Kiplinger chose as their top 10 stocks to get into if you're interested in oil stocks for 2024. And if you've held any of them over the past couple of years, you've probably done well and you're quite happy with the performance. But you can let me know in the comments what you think and perhaps expand the list beyond my top 10. As I said, I'll put a couple of links to some of my small cap stocks that I am invested in, and there are videos where you can actually not only see interviews with the CEOs of these companies, but also take a look at the company with a little bit more depth and detail. So that's it for now. So on this note, I'll sign off, and I look forward to your comments, and we'll reconnect soon. Take care. Bye-bye.